What if I told you that every single major financial crash over the last century, I'm talking 1929, 1987, the dot-com bust, 2008, what if they all followed the exact same five-stage pattern? It's a pattern that Wall Street and the Fed, well, they get it. But most people, they never see it coming until it's way too late. And here's the kicker. That pattern is happening, again, right now. So let's break it down. Okay, picture this. It's September 5th, 1929. A guy named Roger Babson gets up on stage and says these exact 9 words. And you know what happened? The whole room laughed at him. Newspapers called him a fool. Well, just 47 days later, the stock market completely collapsed, kicking off the Great Depression. The thing is, he wasn't just guessing. He was seeing a pattern. And this, right here, shows you exactly what was on the line. While Babson was seeing all the warning signs, the most famous economist of the time, a guy named Irving Fisher, was going around telling everyone that stocks had reached a permanently high plateau. Well, when the dust settled, Fisher had lost literally everything. Babson, on the other hand, made a fortune. The difference wasn't about who was smarter, it was about who's paying attention to the pattern. So yeah, Babson wasn't using some kind of crystal ball. He had a system, a checklist of 5 key factors that show up, without fail, before every single market meltdown. Let's take a look at what they are. Here we go. It's a 5-stage roadmap. It starts with a credit explosion. Then the market gets super concentrated. After that, the smart money starts to quietly sneak out. Then, liquidity, the lifeblood of the market, dries up. And finally, the whole system is just waiting for a trigger. So the billion-dollar question is, where are we on this roadmap right now? All right, stage 1, it always starts with the credit explosion. This is the starting gun for every bubble. It's not really about greed, not at first. It's about a massive, system-wide expansion of debt that just fuels the whole fire. And what this does is create this really dangerous feedback loop. See, people borrow money to buy assets like stocks or houses. That buying pushes the prices up. When prices go up, people feel wealthier. So what do? They borrow even more money to buy even more assets. It feels like a party, like this incredible boom. But really, it's a trap being slowly set. And what's fascinating is how the kind of debt changes over time, but the pattern itself is identical. Back in 1929, it was all about margin debt, borrowing money to buy stocks. In 2008, it was mortgage debt for houses. And today, well, today we've got the everything debt bubble. Margin, corporate, government, you name it. I mean, the scale today is just staggering. The U.S. national debt alone is over $34 trillion, and that's just one piece of the puzzle. When you add in all the corporate debt and margin debt, our total debt compared to the size of our economy is actually higher than it was right before the 1929 crash and higher than it was before the 2008 crisis. So stage 1, it's not just flashing red, it is on fire. All of this debt flows directly into stage 2, what I call the concentration trap. This is the point where the health of the entire market becomes dangerously dependent on just a tiny, tiny handful of superstar stocks. I mean, just look at this. Right now, the top 7 biggest stocks in the S&P 500 make up over 30% of the entire index's value. Think about that. So when you buy a so-called diversified index fund, you're not actually buying 500 companies equally. No, you're making a massive, concentrated bet on just a few names. And these 7 companies, the Magnificent 7, they're amazing businesses, no doubt, but they're now carrying the weight of the entire system on their shoulders. And what's worse is that passive index funds just make this problem bigger and bigger. Every dollar you put into an S&P 500 fund automatically buys more of these top stocks, pushing their prices and their concentration even higher. It's a momentum machine that feels fantastic on the way up and is absolutely brutal on the way down. Okay, the next 2 stages are where things get a little sneaky. They happen quietly, kind of under the surface, usually while the talking heads on TV are telling you that everything is great. This is the silent exit. Stage 3 is the smart money exit. Right before every crash, you see the same thing. Corporate insiders, billionaires, the big institutions, they quietly start selling off their shares. They don't send out a press release, of course. In fact, they usually say the exact opposite in public. They sell to the unsuspecting public, who then become what the pros call their exit liquidity. And hey, don't just take my word for it. The data is screaming right now. The ratio of corporate insider selling compared to insider buying is at historic extremes. The very people who know their companies the best, the CEOs, the top executives, are selling their own stock like there's no tomorrow, all while telling you to stay invested. And that brings us to the sneakiest stage of all, The liquidity illusion. Okay, think of liquidity as the oxygen for the financial markets. When there's plenty of it, everything feels easy, trades run smoothly. But when it's being quietly sucked out of the room, the whole system becomes incredibly fragile, ready to break at the slightest touch. And that is exactly what the Federal Reserve has been doing. First, they raised interest rates at the fastest pace in 4 decades. Then, they started pulling hundreds of billions of dollars out of the system in a process called quantitative tightening. It's basically like running the money printer, but in reverse. And we've already seen the cracks form. Remember the bank failures in 2023 with Silicon Valley Bank? That was a liquidity crisis, plain and simple. Stage 4 is active. The oxygen is being taken out of the room. So, if the first 4 stages have loaded the gun, what finally pulls the trigger? Well, that brings us to the final and most unpredictable piece of this whole puzzle. Now, this is a super important point that almost everyone gets wrong. The trigger doesn't cause the crash. The system was already broken. The debt, the concentration, the lack of liquidity, that's the cause. The trigger is just the match that lights the fuse. In 1929, it was some small-time fraud case over in London. In 2008, it was Lehman Brothers going bankrupt. The trigger itself is almost random. It's the fragile system that really matters. If you look back through history, when these first 4 stages are all flashing red, just like they are now, the trigger event tends to show up within the next 12 to 24 months. That timeline puts us squarely in a window of extreme vulnerability, all the way through 2025 and into 2026. The system is primed. It's just waiting for that match. So look, trying to guess the exact date or the specific trigger is a fool's game. It's pointless. The real question isn't when it will happen. The question is, knowing that all the preconditions are met, what are you going to do about it? So I want you to ask yourself, how much of your own money, your own retirement savings, is sitting in funds that are unknowingly concentrated in those same 7 mega stocks we just talked about? Do you even know? And be brutally honest with yourself on this one. If the market had a 2008-style crash tomorrow and dropped 50%, would you be okay? Or would it completely wreck your financial plans for the next 10, maybe 20 years? You know, ultimately, it all comes back to this simple choice. You can be an Irving Fisher, a brilliant guy who ignored the obvious signals and lost everything. Or you can be a Roger Babson, who saw the pattern, prepared himself, and not only survived, but actually came out ahead. The signals that came before every major crash of the last 100 years are here again. Nobody really warned people in 1929, and they definitely didn't warn them in 2008. So consider this your warning. The pattern is the warning, and now what you choose to do next, well, that's up to you.